Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the ACCC site, my own website, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz or at Banking Day. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 35 in our series for 2024, and today's date is Friday, September the 27th. First, I'll be talking to JobbAdder's Chief Product Officer, Joel Delmaire, about the risks to business and the community of using AI and what sort of regulation is required to ensure community safety without hampering innovation. And I'll talk to Indeed economist Callum Pickering about the latest unemployment figures and what they mean for the Reserve Bank of Australia. But first, let's talk to Joel Delmaire.
Well, Joel, what are the issues with AI that the Albanese government's trying to address?
So the Albanese government, I think, is following what we've seen around the world with governments trying to act, and rightly so, try to mitigate the risk for the population with the release of the new wave of generative AI, which is, I think, has a much broader purpose and area of deployment than the previous AI. And so the kind of problems that you can think about is everything related to human rights, discrimination, risk to security, data privacy. I think the domain where these AI models can be applied is so broad that pretty much every part of our day-to-day life has the potential to be impacted. And so the government is rightly looking at what could happen in that space.
So how specific can the legislation be and how should it be?
It's a very interesting question. I think the government is really trying, on the one hand, to protect citizens, which is its job. On the other hand, it has stated explicitly that it wants to provide clarity for the businesses so that they can operate on the right side of the law and have certainty and progress. The challenge is, if you want to do that, you can become very, very much over-specific in the way you prescribe the way of working with AI and essentially put a burden that's quite significant, especially for small companies, in terms of applying the regulation to the point where you stifle innovation. And we've seen that with other technologies in the past. It's a really hard line to balance, specifically because the problem is so broad.
One of the big issues with, all technology, but particularly AI, is that a lot of companies don't get it. They don't understand it yet.
Yeah, that is very true. I mean, keep in mind the technology is only 2 years old, right? Like generative AI is really, really young in the industry, and by far and large, it takes a lot of time for companies to understand it, adopt it, use it in the right way. And I would not say that today it's been widely used or widely deployed. So this now is probably the time to really look at the right kind of usage. But I would imagine in the next 2 to 3 years, you're going to see like an explosion of use in our day-to-day life.
You would also see an explosion of AI specialists coming on board.
Maybe, but I'm not convinced that we can train people fast enough. That's another aspect of the regulation, which is it makes the assumption that companies are going to be able to find the talent and the people who can actually work and comply. And it's a very tricky profile to find, because you need, on the one hand, to be familiar with legislation, regulation, on the other hand, being quite deep in the technology. And there's very few people on the market that can do that. And so if every company has to start complying in that space, that's going to be certainly tricky.
So that means a lot of companies will struggle over the next 5 to 10 years.
Quite possibly. It might be the challenge in that space is it might create a very uneven playing field, right? Like companies who are probably bigger and can afford the resources or attract the talents or pay premium talents are going to be able to play. And you take the risk of having smaller companies really struggling or being pushed out of the ability to work in that space. Like, I would be very concerned if I was a startup who was trying to build my new business on something that's backed by AI today, with what could happen in the short term for me.
Well, the figures I saw lately was that Australia only had a handful of specialists in AI compared to other markets.
Yeah, that is very true. And I'm not sure that our education system is even geared to be able to react in a sufficient way to build talent, right? So you're going to end up in a place which we've seen to some extent in the technology industry in the last 10 years, where you have to go and source your talents overseas. But if the same regulation pass in every part of the world, then you get into a global war for talent, which is, I guess, that's also another area that the government is always thinking about in terms of immigration and so on.
Look, that's quite true, but companies can always take on AI specialists without necessarily bringing them out here.
Yes, to some extent. I think one of the good points is that most regulators seems to be by and large going in the same direction in terms of regulation. And so hopefully we don't end up in a place where you have pockets of totally different legislation between the EU, the UK, the US, and Australia. And actually, it's one of the stated goals of the government's paper to have coordination with international regulation. So I take that as a positive, and that is well thought through. There's still going to be differences by market, and whether an overseas talent can really wrap their head around the specificities of the Australian market. I think it's maybe, but I'm not 100% convinced.
Look, the other big issue too, of course, is that there are ethical concerns about the use of AI.
Mm-hmm.
Are there not?
Yeah, there are. And it's interesting because the government, rightly so, is picking areas where there is high risk. Like part of the proposal that they've put out there is not to say you need to indiscriminately regulate AI everywhere. It is really targeting the sectors where you could have discrimination, biases, and really negative impacts on everyone's life. The one challenge I see is it's really hard to go and pinpoint where exactly the risks are and be prescriptive from a regulatory perspective on where the risks are. Can give you an example. I'm operating into the recruitment industry, and there is massive risk in that space, right? Like it's very, very simple. Like recruitment is a process of selection, and you can very simply have biases, whether conscious and unconscious, apply to the recruitment, to the selection process. And AI can absolutely replicate these biases or make them even worse. So totally agree, it's a high risk sector. But there are some use of AI in that space that are not risky. Like if you think some very mundane application of generative AI, you receive an email from a candidate that says, I'm available for an interview on these 3 dates. You process that with AI, and then you pick the right date and you book that in the calendar. That is technically in the recruitment industry, it's not a high risk use case, right? And so the granularity and the ability to really manage where you want to be careful and where you don't is quite complex. And I'm not sure that regulation can capture or can adequately manage that complexity. They're certainly going to try, and I think they're doing a good job at trying, but whether we're going to succeed, that's a different story.
Well, one of the big issues that I find personally with AI is that it's just so crude, because it just generally just scapes the internet and just brings you anything it can find on the internet, and not all of it's good.
Yes. But I think, the problem that the internet is not good is it's probably a 20 year long story, and we have the same problem in social media and in other places. It is true that the challenge, I think, with AI is it looks smart, right? When you look at some of the answers, it looks convincing, and it can say absolutely the wrong thing and be 100% wrong in a way that looks very true. And I think that's one of the big challenges of how do you keep people's awareness, how do you signal that there is a possibility of your answer being wrong, and how do you manage these cases where it might be. One of the simplest answers is where you always have a human in the loop and you always have someone checking the answer, but then you lose some of the benefits. So you probably want to do that when it's really critical that you don't get it wrong.
I've always found AI is very good, but you always need a human being to vet it.
In the general AI, I would tend to agree, unless the decision is not that important, unless it's not a big deal, right? Like if you schedule an appointment, like I was taking my previous example where you automatically schedule an appointment, if you schedule it on the wrong day, big deal, right? Like, okay, you're going to reconvene, you're going to jump on the phone. It doesn't matter so much. If you're discriminating against a candidate because of their gender, well, that's a very different story, and that's a very big problem, right?
Yeah. So, which is why you would need a human to vet it.
Keeping in mind that humans are also biased, consciously or unconsciously. So the interesting point in the recruitment industry is when you think about AI, you probably want a human in the loop. And you probably want to make sure that your AI is never more biased than the average human, but you're never going to be able to fully protect to the problem that we are human and we are biased.
Right. Okay. So the critical issue is having the right rules in place without actually jeopardizing businesses' innovation
Mm-hmm.
and ability to use it properly. And at the same time, having lots of protections in place.
And I think the other challenge I would add is the challenge of compliance enforcement. Like we see the government today already struggling with like really big US companies when they try to apply legislation, and it takes years and a lot of forth and back to try to get these companies to comply, right? So are you going to end up in a place where the people who are trying to do the right thing onshore, because they immediately subject to the legislation, get behind company offshore who develop whatever they want and then go to Australia, don't care too much, and the government doesn't really have teeth to enforce for them what the right thing is.
Right. Okay. Well, Joel, it's been fascinating talking to you.
Thanks.
I'm sure everyone will be very interested, and thank you so much for your time.
Have a good day.
And now let's talk to Indeed economist Callum Pickering.
Well, Callum, unemployment came in at 4.2%, seemed to be pretty stable. What's your view about that?
Well, it only looks stable because of a little bit of rounding. So if we look at it from 2 decimal points, for example, you could say that it was down by around 0.1 percentage points. So non-rounded last month was awfully close to rounding to a 4.3. This month was a little bit closer to almost being a 4.1. But because of the rounding, it looked like it only stayed at 4.2%. So I think I would characterize that as being a pretty solid result at this point in the economic cycle. We were obviously expecting the unemployment rate to drift upwards over the course of the year. So the fact that it has managed to decline a little bit, even if you can't quite see it in the headline figures, should be viewed as a positive.
The employment gains were mainly concentrated in part-time roles, is that right?
Yeah, that was certainly the case in the month of August. So full-time employment actually declined by a little bit. It was down by around 3,000 people, whereas part-time employment increased by about 50,000 people. So very strong growth in part-time. Now, what's interesting, though, is if we take a step back and look at what we've seen over the course of this year, we can actually see that around 3/4 of all employment gains have been full-time jobs. So the month of August is actually a little bit of an aberration compared to what we have seen over the course of this year. We still have an economy that is creating a lot of high-quality, high-paying roles, but evidently that wasn't necessarily the case in the month of August. So I don't think we should be too concerned around what we saw in August, with job growth obviously being more part-time, because of that sort of broader trend that we have seen over the first 8 months of this year.
But we're still expecting unemployment to drift upwards over the course of the year?
That's certainly the expectation, yes. I mean, obviously monetary policy is quite tight. The economy itself is growing at a very slow pace, sort of teetering on the brink of recession, which all suggests that the unemployment rate should be drifting higher. The Reserve Bank of Australia expects that the unemployment rate will be 4.3% by the end of this year, 4.4% by the end of next year. What we're seeing in the job market at the moment appears to be broadly consistent with what the RBA expects. And it's certainly something that I tend to agree with. I think it makes sense for the unemployment rate to drift higher. I think there's probably some risks that it increases at a faster pace than the RBA expects. Certainly at this point in time, we are sort of tracking along with those RBA expectations.
What about the participation rate?
Well, it jumped to a new record high in the month of August, so 67.1%, which is well above where we were before the pandemic began. It's been one of those results. It's probably come as a little bit of a surprise. I'm someone who's been looking at the participation rate for much of the last 10 to 15 years in the various roles that I've had. And the long expectation was that the participation rate would begin to drift downwards. And the reason for that was that Australia's ageing population would weigh heavily upon participation in the workforce. And it obviously hasn't eventuated. And there's been a few reasons why that has been the case. So one is, I guess, greater emphasis on work-life balance, which has encouraged a lot of women to enter the workforce. And we've seen participation by women, surge over the past decade. A second reason is that older workers are remaining in the workforce for longer than they traditionally did. So the baby boomers aren't retiring as their parents and previous generations did. A lot of them are staying in the workforce for much longer, sometimes shifting towards more part-time or casual jobs, but they're not sort of retiring as the moment that they hit retirement age. And the third factor, and probably the one that's having the biggest impact, certainly in the last year or two, is the cost of living pressures, which is that participation is rising because of a certain desperation, a need for more money to deal with higher mortgages and rents and food and electricity costs. And so that's encouraging a lot of people to enter the workforce, particularly women sort of trying to get that second income, which is driving participation up to rates that we haven't seen before.
Now, what's interesting, though, is that the jobs figures actually go to the question of inflation. With more people working, it's going to drive up inflation, which would be a concern for the RBA, wouldn't it?
Well, it is certainly one part of the equation. When the Reserve Bank tightens monetary policy, they're looking to slow economic growth. They're looking to slow employment growth as well. One of the reasons why inflation hasn't come down perhaps as quickly as the RBA and other economists expected is because the job market itself is proven to be far more resilient than I think even the most optimistic of economists expected. With monetary policy so tight, even with economic growth, relatively weak, that the fact that employment is up by 374,000 people over the past year, which is just an outstanding annual result, is really quite remarkable. And that's obviously supporting spending, retail trade, the economy more broadly, which is one of the reasons why inflation hasn't come down as quickly as expected.
Right. So what does that mean for the RBA in its next meeting?
Well, I think the resiliency of the Australian job market means that if the RBA feels as though they need to hike rates, they can be pretty confident in the ability of the economy to absorb that if necessary. So there is a lot of conversation at the moment that the RBA's next move is going to be down, and that's certainly what the market expects. That's what a lot of economists expect. But I don't think it's clear-cut. The RBA certainly has a little bit of a hiking bias at the moment based on all the communications that they've had. There's a lot of concern around service sector inflation, how persistent that's been. There's also a lot of concerns around wage growth versus productivity, which suggests that it's far from clear-cut to me that the next move will definitely be down. I think it's going to be data dependent. If there is a significant divergence from RBA expectations, whether that be with regards to the job market or inflation, that could trigger a move from the RBA. And it won't necessarily be down. It could certainly be up.
The issue, too, is that the Fed this week actually cut rates by 0.5 percentage point, which is quite big. And so wouldn't that put pressure on the RBA to cut rates?
Look, certainly historically, there has tended to be movements across different central banks in the same direction. So the fact that other central banks are beginning to cut rates, and we obviously saw that with the Fed making a big move this week, would certainly be, a sign that maybe the RBA will follow suit. But we've got to remember that our macroeconomic conditions and dynamics are a little bit different from the US. For example, if I just look at the job market, I look at the data on Indeed, we can see that job creation in Australia is so much stronger than it is in the United States. There is an incredible number of jobs available across Australia with, job postings about 60% above pre-pandemic levels. Whereas if you compare that to the US, their job posting levels are pretty much in line with pre-pandemic levels. They've come down a lot. There isn't quite that competition for talent, which is then not feeding over into higher wage growth and inflation. Their inflationary situation is very different from ours. So I think, we need to be mindful that there are some things going on in Australia which are not happening in other countries. We may shift towards what we are seeing globally over the next, say, 6 to 12 months. But right now, based on our economic dynamics, our inflation, our job market, it would be very hard to justify cutting rates compared to the sort of arguments that are taking place in the US and across Europe.
Given that, though, the inflation rate, well, yes, it's coming in at 3.8%, which is a lot higher than the target band, but it's heading in the right direction. It's going down.
Look, it is gradually declining, a little bit slower than I think the Reserve Bank would like. But we also need to be mindful that it's going to be influenced over the next year by a range of federal government subsidies, particularly around the electricity sector, which is going to make inflation seem a lot lower than it actually is. The Reserve Bank is going to ignore that. They're going to look at inflation while trying to strip out the impacts of subsidies and things like that. So it's quite possible that we could be looking at official headline inflation of, say, 2.5% early next year. But the reality is going to be very different once you strip out subsidies and things like that. And as a consequence of that, I think inflationary pressures remain quite heated in Australia compared to elsewhere. The Reserve Bank's going to incorporate that. They're going to think about that. They're not going to overreact to headline inflation coming down because of what's driving that. They want to see sustainable easing of inflation. They're going to be looking at, the components in the service sector. So they're going to be taking sort of a broader look at things. They're not going to overreact to the fact that, inflation or prices for electricity have dropped sharply due to subsidies.
So they'll look at the overall picture, and it's agreed that inflation is still quite sticky.
Well, that's right. Yeah, certainly in the service sector, it's just not coming down that fast. I mean, it's gradually coming down, but it's proving to be, very resilient and very persistent. And that is a concern. The RBA is very concerned around inflation becoming entrenched in expectations. And so they want to ensure that that doesn't take place, which means they need to sort of keep monetary policy quite tight. I think there's probably an argument to be made that maybe they should have been a little bit more aggressive, certainly last year and maybe even into this year in order to have inflation come down a little bit faster than expected. But I guess that's sort of the situation we're in now. So I don't think they're going to cut prematurely if it still seems as though there is that risk that high prices and high inflation does become entrenched.
There's a view that the RBA will probably cut it around about February, March.
That's certainly the consensus view at the moment, but I think there is a few boxes that need to be ticked before that eventuates. Obviously, service sector inflation coming down further is something that needs to take place. We need to see more evidence of that. And I think we need to see some, pretty big improvement on the productivity front. Right now, wage growth is still very high and Australia's productivity performance is dreadful. The gap between those two needs to close, and it needs to close so that the RBA can be confident, not just in getting inflation back to the 2 to 3% target, but more importantly, staying there. It's relatively easy to get back to it, but actually staying there consistently and on a sustainable basis, which is what the RBA wants to achieve, will be incredibly difficult if we have the combination of very high wage growth and dreadful productivity growth. And that's obviously the situation we have at the moment.
Well, Callum, it's been great talking to you again, and thank you very much for your time.
And thank you, Leon.
Well, Michael Ferroli, JP Morgan's chief US economist, was one of the only forecasters on Wall Street who accurately predicted the Federal Reserve's half-point rate cut last week, and he sees the same thing happening again. Central bankers will meet again on November the 6th and 7th, and Ferroli expects another 50-point reduction, although that's conditional on the next two job reports showing more weakness. Job gains that came in stronger, however, would seal the deal for the Fed's Goldilocks scenario of quarter-point cuts at the November meeting, and the one in December, he added. Investors are split nearly evenly between 25 points and 50 points for the November meeting, according to CME's FedWatch tracker. And the so-called dot plot of the Fed officials' forecast suggests they anticipate 2 quarter-point cuts by year's end. For his part, Fed Chair Jerome Powell cautioned that the Fed's big move this month is not indicative of subsequent rate moves in the easing cycle. Ultimately, what we found most important in what Powell said was also among the least surprising things he said. Future decisions are going to depend on the data, Ferroli observed. If labour markets continue to soften, we could see more large cuts ahead. If job growth and the unemployment rates stabilise, the path is clear for a gradual move back to neutral. Meanwhile, economists at Bank of America also see a half-point cut in November. After that, they see a series of quarter-point cuts until the Fed funds rate hits 2.75% to 3% sometime in 2025, down from 4.75% to 5% today. At Citi, economists have taken a dim view of the economy, or several months, warning that a recession is likely. They also expect a half-point cut at the next Fed meeting, with the outlook tilted to more large cuts in the future. Powell struggled to explain why the labour market would stabilise around current levels and not continue to deteriorate further when rates will still be at levels the Fed deems restrictive for at least another year, Citi wrote in a note on Friday. And given that he described the 50 basis point cut this week as a commitment to not get behind the curve, we think the bar for a continued weakening employment trend to prompt additional large rate cuts is low. And over on the other side of the world, Australia's central bank held its key interest rate at a 12-year high on Tuesday as it struggles to subdue stubborn price pressures that are holding it back from joining a global easing cycle. The Reserve Bank of Australia, as expected, kept its cash rate at 4.35% for a seventh straight meeting and restated it isn't ruling anything in or out on policy. The RBA has sought to hold on to significant post-COVID job gains, and as a result inflation is taking longer to come down. The RBA's decision highlights its outlier status compared with peers. Last week, Federal Reserve Chair Jerome Powell led his colleagues to an outsized rate cut designed to preserve the strength of the US economy. Economists generally expect the RBA's rate-cutting cycle to begin in February, while financial markets see a 2 in 3 chance of the first easing coming in December. Governor Bullock has repeatedly pushed back against talk of near-term easing, reflecting forecasts that inflation will only return to the 2 to 3% target in late 2025. That's brought her into the political firing line from members of the ruling Labor Party and minority parties that are pushing for a rate cut. Yet, inflation in Australia dived last month to its lowest rate in 3 years as government cost of living relief helped household budgets. The Reserve Bank, though, will wait for a more sustained drop before it starts cutting interest rates. Headline consumer price inflation in August was 2.7%, the Australian Bureau of Statistics said on Wednesday. That compared with the 2.7% rate expected by economists and July's 3.5% annual pace. The underlying inflation measure, which strips out more volatile price movers, also fell. Known as a trim mean, this gauge came in at 3.8%, unchanged from July. While the inflation slide will be welcomed by household, it is unlikely to sway Reserve Bank Governor Michelle Bullock. She wants to see the more comprehensive September quarter numbers due out on the 30th of October, but is doubtful the drop will be yet enough to prompt another interest rate cut. And in another important piece of news, Reserve Bank of Australia Governor Michelle Bullock is developing a backup plan to manage big operational risks such as cybersecurity and its $1.1 billion building renovation if the Albanese government fails to achieve its proposed shake-up of the central bank's board. A political impasse over the plan to create a recommended specialist monetary policy board and separate governance board has forced the bank to explore setting up a range of subcommittees potentially chaired by existing RBA board members and staffed by RBA officials. Commonwealth Bank Chief Executive Matt Coman runs a similar model. The potential Plan B model at the RBA would enable specialist advice to be fed to the 9-person RBA board to enable Ms Bullock to better share governance responsibilities with other experts. Ms Bullock said on Tuesday the RBA had important responsibilities beyond monetary policy, including being the government's banker and managing welfare payments, operating the nation's critical payment system and wholesale cash distribution. All of these things are really important functions of the bank, and at the moment I'm the sole accountable authority for those, she said. I think that it would be good for us to get some structure, and I think we can, even if we don't end up with this new dual board structure. Treasurer Jim Chalmers' plan to create the two boards is on life support after the Labor government ruled out working with the Greens, who on Monday demanded an interest rate cut in exchange for their support. The decision means the RBA's 6 current external board members will continue to set interest rates, despite an independent review of last year finding the group collectively lacked the expertise to effectively to do so. And for Australians, the misery index is at its highest level since the global financial crisis, and higher than during the COVID-19 era, when we seemed universally fearful for our health and economic future. Authors of this index, the economic think tank CEDA, described it succinctly. Australians are living through the most protracted period of economic misery since 2011. The misery index is influenced by a mix of inflation, or the consumer price index, the unemployment rate, and interest rates, with a dollop of GDP thrown in. While the index improved in 2022-23 after the worst of the pandemic had moved through the economy, a misery level has picked up again. In particular, the upward tick in the past quarter appears to be affected by unemployment creeping up as the economy continues to soften. It highlights the difficulty of the task facing the Reserve Bank Governor Michelle Bullock, who is attempting to balance the misery caused by inflation and the misery created by high interest rates. This balancing act is also complicated by the desire to keep the economy growing and the aspiration to retain strong levels of employment. Unfortunately, Bullock's only tool is to address this change. Raising interest rates also inflicts pain. As the index clearly shows, the combined effect of 13 rate rises since May 2022 and inflation is, well, miserable, says the CEDA research paper on the misery index. And the Albanese government has started work on options to scale back negative gearing and capital gains tax concessions, preparing the ground for a bold new housing policy that could define the federal election. The Albanese government has asked Treasury for expert advice on the possible changes after years of dispute over billions of dollars in annual tax benefits, as the Greens demand an end to the tax breaks and the Liberals warn against the hit to investors. Prime Minister Anthony Albanese sought to brush off questions about negative gearing last week after Greens leader Adam Bandt spurned a deal on housing policy in the Senate, leading opposition leader Peter Dutton to call on the government to be honest about its plans. While it is common for governments to ask officials to assess policies without proceeding with the changes, the modelling work shows that Labor is prepared to take an ambitious agenda to the next election. And the Australian Competition Consumer Commission, the ACCC, has launched legal action against Woolworths and Coles. The ACCC alleges the supermarket giants breached consumer law by misleading consumers through discount pricing claims on hundreds of products. The ACCC has alleged both companies sold items at irregular prices for up to 6 months, then increases the prices of those items by at least 15% before being placed in the prices dropped Woolworths promotion or down Coles promotion. The ACCC alleges up to 266 products were involved in pricing claims by Woolworths at different times over an estimated 20-month period, and 245 products for Coles over a period of about 15 months. Some of the Woolworths products included Tim Tams, Dolmio sauces, Doritos salsa, Energizer batteries, Kellogg's cereals and hundreds of others. Coles products included Arnott's Shapes biscuits, Band-Aids and Cadbury chocolates. Following many years of marketing campaigns by Woolworths and Coles, Australian consumers have come to understand that the prices dropped and down promotions relate to a sustained reduction in the regular prices of supermarket products, ACCC Chair Gina Cass-Gottlieb said. However, in the case of these products, we allege the new prices dropped and down promotional prices were actually higher than or the same as the previous regular price. And revenue at PwC Australia fell by more than a quarter, or $820 million, to $2.35 billion in the year to June, marking its worst slump on record due to the ongoing fallout of its tax leak scandal and a subdued consulting market. The firm, once a preeminent consulting outfit in the country, has now fallen to third place by revenue behind Deloitte Australia and EY Australia. It remains ahead of KPMG Australia. PwC's profit fell by 24% in 2023-24, but average partner income declined by only 13% due to top-up payments made to help them with unexpected tax liabilities. The firm also propped up its earnings through a concerted cost-cutting program which involved hundreds of staff redundancies and dozens of partner cuts. Average partner income at PwC is now about $765,000. This compares to average partner income of $814,000 at EY, $650,000 at KPMG, and $510,000 at Deloitte. An organised crime boss, George Alex, boasted the CFMEU deemed his firms untouchable on building sites because union officials needed their kickers, according to police surveillance. The covert police recordings of Alex capture him at his luxury beachside apartment in Surfers Paradise, telling disgraced Kiwi businessman and co-conspirator Mark Bryers the CFMEU would not touch his labour hire firms in industrial scrap with Multiplex. The CFMEU always do that, but not with me. You do that for everybody else, but you don't do it for my blokes. My blokes are untouchable, Alex says. They can't do it with our guys, can't. F them. They need their kicker. They need money, the union. They come to us so they need us to make money. The police recordings, released by New South Wales Supreme Court, offer a further glimpse into the sweeping building industry empire Alex built on Australia's east coast in the decade after a 2015 Royal Commission outed him as a criminal figure who had bribed union officials to win CFMEU favours. The recordings from 2019 and 2020 also capture Alex's criminal lieutenant complaining that a union agreement he secured for a tax-dodging firm did not come cheap. Alex was convicted earlier this month of tax fraud and money laundering rather than corrupting union officials or building company bosses. But the release by the court of phone tap and listening device recordings appear to back up the Commonwealth DPP's case that Alex's criminal operation was able to flourish because of his skill at leveraging contacts in the trade unions and big building firms. Alex's labour hire firms, which supplied workers to big construction projects, were used by him to launder dirty money, including suspected drug dollars, and wrought the tax office of millions of dollars. CFMEU Administrator Mark Irving KC, who was appointed to take over the union, has indicated in public statements that he intends to pick up where the AFP investigation into Alex left off, scrutinising the way Alex and other Labor hire bosses may have corrupted the union and building companies. But while Irving has compulsory powers for interviews and to produce documents, he has no ability to tap phones, use listing devices or access police information. And the growth in care economy jobs has been 70 times faster than the rise in construction sector roles in the first 2 years of the Albanese government, with builders warning Labor that they're falling drastically short of the workers needed to meet its housing targets. The number of employees in the construction industry rose by just 2,772 to 1.22 million in the 2 years to June, according to analysis of Bureau of Statistics data. With the size of Australia's workforce rising by more than 850,000 people over the same period, the growth in the construction industry has been outstripped by a host of other sectors, including roles in social assistance and healthcare or care economy sector, which has swelled by more than 336,000 to 2.37 million. Construction lobby group Master Builders Association, MBA, said the industry's workforce needed to increase by 130,000 by 2029 if Labor were to have any chance of delivering on its promise to build 1.2 million well-located homes in 5 years, alongside additional supporting infrastructure. While the group's chief executive, Danita Warren, said there would be no quick fix to the continued workforce shortage facing the building construction sector, she advocated for a whole-of-government approach across migration schools and industrial relations portfolios. Despite challenges, the industry is in a unique position to grow and innovate, Ms. Warren said. There is a growing pipeline of work for the industry across the housing, commercial and civil sectors, presenting a great opportunity for people to join, including among the MBA's recommendation to government is the establishment of a specialist construction skills pathway visa akin to similar programs in Canada, New Zealand and Britain, providing applicants with options for permanent residency. Apprenticeships in the building construction industry should be incentivised via commencement and completion bonuses to apprentices and their employers, the MBA has recommended, alongside a wage subsidy through the duration of the apprenticeship. Labor is undertaking a strategic review into Australia's apprenticeship incentive system. The MBA also advocated for state, territory and Commonwealth governments to harmonise occupational licensing requirements and streamline recognition of internationally comparable qualifications. That increase of 130,000 new additional workers would need to come on top of the significant number of people permanently exiting the industry each year, which the MBA estimated was more than 100,000 due to retirement of baby boomer tradies. And Australia's REA Group has made a second takeover proposal for Britain's largest property listing company's Rightmove, valuing the business at close to £5.9 billion. REA's bid marks roughly a 7% increase from its previous offer, which Rightmove had rejected. Last week, Rightmove said it rejected the initial cash and shares bid from REA as being wholly opportunistic and that it fundamentally undervalued Rightmove and its future prospect. REA, which is controlled by Rupert Murdoch's News Corp, said its initial proposal valued Rightmove's shares at a 27% premium to the UK company's share price before the Australian company's interest was made public. As part of the initial offer, REA said Rightmove shareholders would own 18.6% of the combined company based on its indicative offer. It intended to seek a secondary listing on the London Stock Exchange to allow UK investors to trade the shares, it said. Rightmove has an 80% market share in online property listings, but has warned of slower customer growth. Rival On the Market was acquired last year by US real estate data group CoStar and has since launched an expansion push. Under UK takeover rules, REA has until the end of September to make a formal offer or walk away. And that's it for this week. And next week, I'll be talking to Melrose Health Group's CEO, Nathan Cheong. Nathan is a leading figure in Australia's complementary medicine sector and has just completed a revolutionary new direction for Melrose with the launch of Future Lab, creating Australia's first over-the-counter range of longevity supplements. And I'll be talking to AMP Capital Chief Economist Shane Oliver about the last profit reporting season and what it says about the economy. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. If you like Talking Business, please leave us a review with Apple Podcasts. Thank you in advance. In the meantime, you can find me on Facebook, Twitter, or X as it's now known, Instagram, LinkedIn, and YouTube. If you want to contact me, email me at leon@leongettler.com. I answer all emails. Also, in my spare time, I have a copywriting business. If anyone needs newsletters, blogs, articles or editorial, email me. Wishing you all a safe and healthy week and looking forward to bringing you Talking Business next week.